Hello, everyone. Today on the final bar, we'll do our normal Monday routine, hitting the market from three directions: top-down macro, sector rotation, bottom-up stock picking. The S&P 500, the equity markets in general, getting off to a bit of a rocky start here in 2021, finishing down only about 1.33%. It's down a lot more earlier in the day, but a little buying power comes in. However, a lot of stocks and the S&P itself showing a bearish engulfing pattern, which does not bode well for the short-term environment. Is that the sign of further weakness to come, or more just a standard pullback within a longer-term uptrend? We'll try to tease all those themes out and more. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in a rainy Redmond, Washington. Happy New Year. Welcome back to StockCharts TV, to our series of live programming. Hope you had a great holiday season, time to renew, refresh, relax, take a step back and reflect on a challenging but completed year. So that's good. We made it to 2021 and start to look forward with us as we think about the next chapter. You know, we've had such a great time on StockCharts TV over the last couple of weeks. We had a series of special videos called Reflections 2020. We talked about improving your process. We talked about sector rotation, and we listed out our top 10 charts for the year. And now that we're in the new year, back from the holidays, we'll continue on this momentum of trying to help you make better decisions using all the power of stock charts, power of visualization, and technical analysis. So we have our very, very soon, we will have our 2021 market outlook coming later in January. We're sort of getting all of that lined up and getting it squared away. But I think you're going to be really excited hearing from some of the best experts in the industry, technically oriented, and others sort of focusing on their big picture calls for the year. Now, we have some great guests on the show, and that's one of my favorite parts about the final bar, the fantastic guests we're able to have ongoing conversations with. We're going to start tomorrow with Craig Johnson from Piper Sandler. Craig's joining us from the Minneapolis area. I have frequently had informal agreements or wagers with Craig about the market environment overall, just to set the stage. Usually Craig wins those. Actually, I think he's 2 for 2 out of our two discussions recently, and most recently was me remaining negative coming out of the low last year in March. He turned very positive and was correctly calling for the S&P much higher. So it'll be interesting to hear what he has to think, or he has to say about this year. Chris Brecher from Brecher Trading is joining us on Wednesday the 6th, and then on Thursday, for the first time, we'll have Bob Lang from Explosive Options coming back on the show. We've really tried to focus a little more on the options market in recent months. We'll continue that in the new year, and Bob is one of the best at explaining how to think about options as an investor. Today, we're going to dig into our market recap, as hopefully you know from watching the show up until now. On Mondays, we hit the market from three directions: top-down macro, sector rotation, bottom-up stock picking. And this is really just a touching on each of the three main areas that I focus my own analysis. And I hope that by having a conversation about what we're seeing and what we're thinking, that it can help you, inspire you to dig into your own process and hopefully improve your decision-making process. Let's start with the chart of the S&P 500 and just start from here. You know, as I was doing my weekly routine of analyzing the S&P 500 charts, which usually happens Sunday into Monday, I was struck by the vast number of bearish engulfing patterns that emerged today. Overall, things looking pretty good up until when I started, when the day opened and you started to see the trading sort of come out. A lot of stocks selling off out of the open, opening a little higher, trading a little lower. That quickly creates what's called a bearish engulfing pattern, where you have an up day, which was the last trading day of 2020. Then you have a higher open, higher than yesterday's close, and then a lower close than the previous day's open. So day two, the range from open to close engulfs day one. That's called a bearish engulfing pattern. Candlestick analysis, it's one of the standard reversal patterns. And so what that means, it usually is telling you about the next couple days, and it tells you that the bias is more negative than positive. That's invalidated if the high of today is eclipsed. So if tomorrow we reverse and break above today's high, that would invalidate that bearish engulfing pattern. But more often than not, that tells you some internal weakness. And I'm not terribly surprised by a bit of a pullback. If you caught any of my sort of year-end discussions in December and talking about the next year, I'm seeing 2021 potentially looking a lot like 2010. If you go back in your market history book, you think about the acceleration out of the lows in 2009. We have very similar breadth and sentiment characteristics with some euphoric sentiment readings, acceleration out of the long-term lows. You saw that in 2009. You saw the same thing in 2020. That for me means sort of a backing and filling year, a pausing and mean reversion year tends to happen this year, and so that's sort of the playbook that I have in mind. If you look at 2010, though, you finished up on the year, so the second half of the year a lot more positive, and I wouldn't be surprised if that lines up with what we're seeing in terms of headwinds and tailwinds with a vaccine rollout. Hopefully, economy is able to reopen, and we sort of get back to whatever quote unquote normal is going to look like. So having said that, what's next? On the S&P, we've talked about this shaded area, which is 3550 to 3600. The 50-day moving average ascending is there around 3590 today. So that's a very clear, I think, logical pullback place. So that would be the first objective on a pullback. We've talked about that for a while. I think that certainly makes sense. So a pullback to there is, maybe 10%, 8% off the highs if I think about it. And overall, I think that would be the next place to revisit where we at, what are the conditions, and do we need to think further down, or we think about a bounce higher. It was a tale of two markets from the morning session to the afternoon session. If you look at the S&P selling off in the morning, stabilizing around lunchtime, and then recovering some of that, finding a magnet price right around 3,700, which is interesting because over the last 6 weeks of 2020, you certainly had that 3,700 level. We talked about that a lot. That's where the market sort of rallied to and then traded around for a little bit before resolving higher going into year end. So interesting and poetic of sorts that we're back at that same level. Mid caps and small caps, a little mix. So mid caps down just a little bit more, but not much. Small caps down a little bit less, but everything's sort of down for the day. The VIX back higher, just below 27. In terms of other asset classes, you had bonds, down on the day. It was really sort of a weird choppy day, sort of accelerated out of a lower level, sort of the reverse of the S&P opening low and getting higher, but then, giving a lot of that back at the end of the day. So 10-year yields essentially stable from where they were at. We're going to talk a little bit about precious metals today. And at year end, one of the last charts we looked at was the chart of silver. We're going to look at that again today. Gold and silver both up today, with the SLV up over 3%. The commodity complex as a whole has been structurally very, very positive, and especially on a day like today, if you take the oil out of it, the average commodity was up pretty good, especially the agricultural commodities. And especially the precious metal. So that could be I hesitate to call gold a safe haven because it's not a 100% accurate description of gold. Sometimes it does serve as a safe haven, other times it doesn't. Arguably, you could say something like Bitcoin, cryptocurrencies could be the safe haven right about now. But overall, the chart of gold certainly supporting a higher move. Bitcoin down about 5% today. That's a little bit misleading because over the holidays, you had some acceleration to the upside. Yesterday, the Bitcoin got almost to 35,000, which is crazy because it was not that long ago. We were talking about whether or not it would be able to get above 20,000 and hold it. It certainly has done so, but mean reverting back down, touched 28,500 earlier today, closing around 31,500, just below that. So if you enjoy volatility and uncertainty, cryptocurrency, certainly you could have some fun there with the movements on there. Again, I in general tend to think that the trend is in place until proven otherwise. And I think it's worth noting that something like Bitcoin overall, even down, a couple thousand points today, still overall in a pretty good upward trajectory. That is our market recap for today. We want to transition on, talk about sector setup. So when we think about the big picture, it's all about, asset classes, stocks versus bonds versus gold. And we talked at year end about sort of the long-term trajectory. So far, again, just on today's trading, you have, stocks essentially weak or giving back the gains that we saw, accelerating to the upside into the end of the year, now giving a little bit of that back today, and the bearish engulfing pattern speaking to some internal weakness for the next couple of days. And we didn't talk about the breadth, and I'll go there just very quickly because I did want to mention that the breadth characteristics overall not climactically bad. So if we look at advanced decliners, I was looking at my friend Walt Deemer, who continues to be one of my favorite resources, looking at advanced decliners, usually pretty good at keeping things updated on the Twitters. And he had mentioned it's about a 65% down day, ended up about 70% by my read, just looking at the price changes, not including the volume. And overall, that's not the end of the world. If you look really bombed out days, get 80, 90% even down days. It wasn't an everything's ending. Almost a third of the New York Stock Exchange issues were up today. So it wasn't a complete debacle. It was just certainly giving back the gains from the end of last year. And again, even if you're bullish on stocks for the long term, I don't think a day like today is that bad. It's actually a nice sort of digestion day of giving back some of the extreme gains we saw in December. Let's transition into sectors. In terms of today, only one of the 11 S&P sectors up today, with energy up 0.2%. Most of the S&P sectors down, led by real estate, utilities, and industrials, which are at the bottom of the list. Sort of the middle of the road sectors are the ones that arguably have some of the best signal in them. Communication services, technology. And it's interesting, when I start my S&P review, we'll get to some of those charts in a little bit. But the communication services sector is where I always start, because I just go alphabetically, and that's at the top of the list. And that's where just all of these bearish divergences start bubbling up. Comcast, Charter, Fox, Activision, and Electronic Arts weren't necessarily bearish engulfing patterns, but certainly distributive patterns. A lot of the FANG stocks and so forth. So it was interesting to see that, really finishing in line with the S&P overall today. Let's look at the 11 S&P sectors and how they're rotating around the S&P 500. For this, we tend to use Julius de Kempener's RRG method. This is the relative rotation graph. It's such a great way to visualize the sectors and how they rotate around the benchmark in the middle. Check out his show, Sector Spotlight, if you don't understand this methodology completely, but very quickly, things tend to rotate in a clockwise motion around the benchmark there in the middle. Up and to the right is strong, heading northeast is strong, leading quadrant, which means it's outperforming and the momentum is increasing. That's all positive. Everything opposite to that is negative. Heading southwest, breaking down into the weakening quadrant and then continuing into the lagging quadrant. All those things suggest relative weakness, and it's not based on absolute movements. It's based on relative to the S&P, which is here in the crosshair. So when you look at this chart, what jumps out at me? So obviously the first thing is just visually energy, just broad rotation. I mean, over the last couple months, it's rotated from, far down. I was off the monitor there, far down in the lagging quadrant, up into the improving quadrant, and now potentially back in the leading quadrant for the first time in forever, to be honest with you. It's been a long, I'll have to look back at the tape at the last time energy was in the leading quadrant, but it's been quite a while. It's a huge rotation that you've seen, and certainly speaks to the strength, even with a bit of a give back going into year end, still overall on a relative basis impressing. Financials number two, and it's very closely, the XLF is very close to emerging as the strongest sector on a relative basis. Industrials still hold that, being furthest to the right. But in terms of strong trend and improving momentum, it's financials and it's energy, number one and number two. The other one to watch right now, I would say, is technology. You can see how it's rotating more northeast. And one of the most sort of profitable ways I've found to use this is look for, everything tends to rotate in a clockwise direction, not all the time, but usually. And what's really interesting is when things do a clockwise rotation, but to the right of the zero line, because what that means is it's outperforming the S&P overall pretty much continuously. It's just whether the momentum is increasing or decreasing, and that's what the y-axis is telling you. So things that rotate over here, which is what technology is kind of doing, tells you that technology is relatively strong, and it tells you to want to stay with something like that. Semiconductors are one of my favorite big picture tells in terms of a particular group. Overall holding up pretty well today. I didn't see going into the close where they finished. Let's look at the SMH, up 0.2%. So it gave a little bit of a back from opening and trading a little bit higher. Earlier in the day, the SMH was up around 225, and it was one of the better groups out there. Still, overall up on the day, on a day when things are down, which is always kind of an interesting thing to look at. So what else to pay attention to? Now I like to go to the candle glance page, looking at all 11 S&P sectors, and then we have the S&P here in the bottom right corner. And this is a time, if you haven't looked at sector rotation over the holidays, a great sort of reset. Let's see what sectors are in uptrends, what sectors are in downtrends. And a very quick way to do that, which sectors are making higher highs, which sectors are above an ascending 50-day moving average. I am seeing most of them in that situation, except for utilities except for real estate, which really broke off today. And the XLRE is an interesting one to watch, testing that swing low from December. So, an uptrend is higher highs and higher lows. A downtrend is lower highs and lower lows. And real estate since mid-November has really been in that pattern of distribution of lower highs and lower lows. If it breaks that swing low from December, that would certainly be a warning signal. Utilities have a little bit further to go. We talked about this range here, which is the range really for the last 6-7 months, which is around 60 to 61 on the XLU. That's where it rallied in June. We retested it in August, broke out in October, which was pretty impressive. And then you've seen we've retested this level a couple times here. It rallied out of there going into the end of the year, and it seemed like a pretty constructive setup potentially if it was able to break above its recent swing high. It has not. It's failed there. Failed at the 50-day and now back in this congestion range. So you assume that holds. If it breaks 60, I think you would want to start avoiding utilities or consider leaning away from that breakdown. What's holding up the best? It's these things that are holding above their 50-day. And in terms of a key pattern to look at, I would look at the industrial sector. It's right back down to the 50-day moving average. And in general, as you know, with the average sort of stock, plain vanilla, everything ideal, an uptrend is higher highs and higher lows, and the higher lows pull back to an ascending 50-day moving average, and that's sort of the opportunity for things to improve. You can see that happen a number of times here in 2021. After it got back above after the March low, really in May, it sort of got above there for good. You can see a number of pullbacks. It really gapped below there in October, but quickly recovered. And overall, if it's able to hold that ascending 50-day moving average, that would be very encouraging for a lot of those infrastructure names that we talked about. When we think about the presidency, and obviously a lot of headlines, and we'll see if they're headwinds or tailwinds, but certainly uncertainty at bay now with Congress people, sort of affecting potentially the electoral process. We'll have to see how this all plays out, but a Biden presidency, just like a Trump presidency, certainly speaks to the need to invest in infrastructure. And so that speaks to industrials doing pretty well over the long term. We'll have to see, again, on the charts, is it able to hold that sort of ascending 50-day moving average? If so, it's a nice opportunity potentially to get back in and ride the next wave higher. If not, though, you have to start thinking about further risk assessment and potential for further downside. We need to take a quick break. We'll be back with our next segment, Shifting Stocks. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. So thankful that you're joining us here in the new year, and look forward to working with you to help make better decisions and improve your situational awareness, your market awareness through the course of this year. Appreciate you coming on this journey with us. We are here to help you as you run into questions during the normal process of analyzing charts, making trades, learning from your own experiences. So let us help you. The ways to get questions to us, 3 ways. Number 1, via email, thefinalbar@stockcharts.com. Number 2, on Twitter @finalbarsctv. And third, on our YouTube channel, just put a comment right below the video that you're watching. We got some great questions over the holidays. We're going to incorporate some of those, and anything else that comes to mind, just shoot them to us via email or elsewhere. We'll have another mailbag segment on Tuesday's show, and we'll hope to answer one of your questions live on the air. Our next segment, our final main segment for today, is Shifting Stocks. We've now talked about the big picture and this give back that we saw in the major market averages. We talked about sector rotation, things like industrials testing some key support, things like energy and financials, which have really emerged in a position of relative strength, but technology, sort of a bellwether sector, and see if that's able to continue its process of outperformance. Now we get to our third piece, which is bottom-up stock picking. Let's look at some individual stocks and see what themes, pattern signals we can identify. We'll start with semiconductors. As I mentioned, with technology, I think, some of the charts, some of the strongest charts we saw in 2020 were in technology. And if you look at the SMH, just a nice outperformance. Semiconductors, obviously a backbone of the internet, and most of the things we're using are affected by this group in some way or involve these companies. So the strength of this group, I think it's traditionally how Charles Dow thought of the transportation average. It was sort of the infrastructure that kept things going. And I think this group doing well bodes well for the overall market. Interesting to see it actually hold up today, as a lot of things traded negative and showed some bearish engulfing patterns. You didn't get that from the SMH or from a lot of the semiconductor names. So I'd be interested to see if this continues to do well. I would be not surprised in a situation when the market does poorly, if the relative strength continues to hold up in a group like this, because this is a, sort of think of this as a flight to safety. It's hard to think of something more safe than, the backbone of the technology that we're using. So I wouldn't be surprised if this tends to do well, even in a choppy to down market. Let's look a little bit elsewhere, though. As I mentioned, a lot of bearish divergences. I started my analysis in communication services. Charter Communications, CHTR, gives you an example of what I was talking about. So, you can see the up day that you had on the last trading day of 2020, and then you can see the higher open, the lower close. That's a bearish engulfing pattern. Really just speaks to short-term weakness. It's not a long-term signal, but when it happens when a market is at an extreme high, it tells you to be a little wary of further upside, or the potential for further upside. A breakup of 680 on CHTR would certainly invalidate that and suggest further highs are certainly accessible, but interesting to see some bearish engulfing patterns. I won't list all of them, but in a lot of communication services and also consumer discretionary. So if you look at a chart of Starbucks, maybe the most glaring example of that, an up day on Thursday's session, higher open, lower close. On bar charts, by the way, if you use bar charts like I tend to, you call that a bearish outside day, but it's essentially the same thing. Wider range, but lower close. It's the same thing. It speaks to short-term distribution, and Starbucks really leading the move downward. This is coming out of an overbought condition on the last trading session. So interesting to see that actually playing out on a lot of stocks. Higher close going into the end of the year, an engulfing pattern coming out of an overbought region really speaks to some short-term uncertainty and some short-term weakness. Others, Take-Two is another one within communication services, probably all the time I'll spend there, but, bear in mind, there are a lot of those as I'm going through the charts. Let's spend a little more time with consumer discretionary. It's worth noting on a day like today when it felt like everything was down, there's a lot of negative movements. If you look at the FANG charts, for example, there's a lot of negativity. I think it's worth noting stocks that are actually up on the day. So if you look at consumer discretionary, compare something like L Brands with something like Ross Stores, ROST. They're in the same group. One of these ROST down almost 5%. L Brands, ticker LB, which is in the top percentile, 99th percentile, according to our scooter rankings, actually bouncing off the 50-day. So charts like this, where you can't tell that the market was really down, that you can see a bounce off of a moving average, you have to like the long-term trend there. And so I think that's setting up really nicely, up about 6.5% on an analyst upgrade today. Of course, if we're going to talk about strong trends, I have to go with something like Tesla. People love to hate this name, and on social media, it's funny. When I publish something on Tesla, it's just, you rile everyone up, and you rile up a lot of emotional reaction. People either despise the whole idea of this chart and this company, or they love it and swear by it. There's not a lot of middle ground to be had there, which I feel like with a lot of our lives is like that right now. But it remains to be or until proven otherwise, the trend remains in positive territory. It's the number one scooter ranked stock in our large cap universe. It has been up there for much of the last couple months, and until proven otherwise, the chart's going higher. So it's overbought, absolutely. It's going to new highs. I'm tending to believe that until proven otherwise. And overall, there are not many charts with a just consistent, strong price trend characteristics like you see with Tesla. And so again, I'm going to assume that trend continues until proven otherwise. Path of least resistance is up. It's not just the Teslas and the L Brands that were up there. There were some other consumer names that did pretty well today. And if I were you and you're struggling to figure out where to be in an environment that feels a little more uncertain, I would certainly be looking for stocks that did well on a day like today when it felt like everything was down. Tapestry, which is in the clothing and accessories group, up over 5% today. Nice bounce off of a pullback level, pulled back to around 28, just below there a couple times in December, and now accelerating back to the upside. The 50 days right around that same level, which means if it does pull back here in the next week or two, that would be a reasonable expectation for support. Newell Brands is another one, not breaking to a new high, but back up to the range that you had in December. And again, a pullback level here in mid-December, the 50-day right around 20 would be a logical pullback place if you do see some distribution there. It's not all rosy when you look at consumer there, so I'd encourage you to look at some of the things that are not working. Something like Whirlpool concerns me. A lot of stocks like Starbucks down a good bit today, but still within a longer-term uptrend. Something like Whirlpool is a little more concerning because it's breaking down through support. So when you have a distribution day like today, I always say start with the final bar, start with today. Look to the left on the chart and see where today's price action fits into the bigger picture. With something like this, it reminds me of the chart of Regeneron, sort of before it really started to accelerate to the downside. You first, before you went down a ton, you had to find support and you bounced off of it, and then you finally broke down through it. So early September is when this chart started to feel a little less awesome to me. And potentially you're getting a similar pattern in something like Whirlpool, right? It's just breaking down. And so, sort of lightening up a little bit on something like this, leaning away from it, looking for opportunities that are working, as opposed to something like this that's breaking support, could be a really interesting one. We don't have time to look at much more, but other tickers I would throw out at you, something like Kroger was up today, coming off of a pretty beaten down level. This found support a couple times in the last quarter around 30.50. It's bouncing off of that, but back above the 50-day moving average for the first time in a while, making a new swing high. So it's still early on, and I'd love to see it get above this swing high from November, but breaking trend line resistance. If you look at the trend line from the September high, the November high, and where we're at right now, just broke above it today. It might be an interesting one to look at. The other thing, I'd look at things like Bank of America, so there were a lot of bearish engulfing patterns, but something like this didn't even break down below the range from last week. So still holding up pretty well. So that's why I think on a relative basis, things like financials are actually holding up pretty nicely, because they're pulling back, but still not breaking down in a meaningful way. So that SIVB maybe fits in that bucket as well. It's just a nice strong trend, not going higher today, but not really giving back a ton of that yet. So that's the way I would look at some of these, some of the bottom of stock picking. Again, we have a chance to just touch on a couple themes, and I tried to hit on as many as I could. But on a distribution day like today, as a reminder, take a look at where we're at now. Look to the left and make sure you key on some key support levels and manage your risk appropriately. We need to wrap the show. Go to the 3 and 3 charts. 3 minutes. Here we go. Chart number one is a chart of silver. At year end, I mentioned this, and actually I might not have, because it's been quite a while. I can't remember. We've taken a couple weeks off of the show. I feel like it's been forever. I've missed it. But I went on Bloomberg TV the last week of the year and was talking with the host there about precious metals, and my general theme, my general idea is the first quarter is going to be rocky to down for stocks, but that gives an opportunity for something like gold and silver to reemerge. They sort of took the fourth quarter off and we're sort of in a short-term downtrend. You're now starting to see a rotation higher. Gold starting to break out as well, but silver a little earlier on broke above 24 on the SLV, and I'd look for that to hold if it pulls back at all. The 50-day moving average a little bit below there, just below 23. But overall, I think the trend has potentially transitioned from distribution consolidation to more accumulation. And I should point, the 38.2% really has been the ultimate support there, around 21 on the SLV. Chart number two is Tesla, and again, a bearish divergence is what we highlighted in December. Tesla does not seem to care, and charts that ignore bearish divergences a lot of times are just really strong, really capable trends. And in general, a trend is up until proven otherwise. And the chart of Tesla, if you've not believed it by now, I think you have to believe in the strength of this trend, closing higher on a day when the average stock is closed lower. Again, making a lower high, making a lower low, that's what tells you things are reversing downwards more meaningfully. But overall, I think the trend is positive until proven otherwise. You can't argue with the relative strength and the strength in that move. Chart number three is the home construction ETF, ticker ITB. There are a couple ways to look at home builders. You can look at the individual stocks like Lennar and Toll and KB and those. You also can look at two of the ETFs. ITB is more of a pure play on home builders. You also have the XHB, which includes things like Home Depot, sort of like the home retailers are included in there. The ITB sort of illustrates this weakness that you've seen. Home builders had been pretty good, but sort of holding off of it, and it appears to be a basing pattern here, potentially like a head and shoulders top of sorts, but none of that matters until you break that swing low. So you have to break below 52 to really confirm a distribution pattern here. At this point, it's more consolidation. It's more of a consolidation rotation around this median, around 30, around 56 or so. But overall, I'm looking for a chart like this to hold around 52. And the reason why I'm looking at this example is we've seen with a number of charts, with Whirlpool, with Regeneron type charts, when you start to distribute a little bit, it's always important to look to the left and see if support levels are able to hold or not. Folks, that is our show for today. Thank you so much for joining us. Pleasure to be back with you live here in 2021, and hope you had a fantastic holiday. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.